Welcome to Her Money Revolution. I'm your host, Angela Brooks, your guide on this journey to becoming a wealthy woman. As a certified financial planner, owner, and advisor at Family Capital Management, I'm on a mission to simplify the conversation around investing and to help women generate more wealth by making their money work for them. Join me as we navigate powerful financial planning strategies to help you achieve your personal and professional goals. This podcast is your go-to destination for no fluff, easy to implement financial and investing advice. If you are ready to achieve audacious financial goals, dream beyond boundaries, and generate massive wealth for you and your family, this podcast is for you. Grab a notebook. Let's get started. Hello, and welcome back to Her Money Revolution, the podcast where we empower women to grow their wealth by making their money work for them. I'm your host, Angela Brooks. In today's episode, we are talking about something that almost nobody understands until it is actually happening to them. And unfortunately, by the time that many people realize it, it can already cost them thousands of dollars. What am I talking about? It's called IRMAA. Now, I know that sounds like one of those confusing financial acronyms that instantly makes you want to tune out. But listen, please stay with me because this topic matters, especially for retirees and for widows, especially for higher income households, and really anyone trying to build a smart retirement income strategy. This could impact you. So IRMAA is not just about Medicare. It is really about the overall plan in your taxes, financial comprehensive planning, income timing, avoiding those costly surprises that could happen later on in life. And the sad part is that many people trigger IRMAA accidentally. They make one large financial move, like maybe they sell a property or they take a big IRA withdrawal. They know they pay taxes, but they don't know anything about IRMAA. Maybe you do a Roth conversion or sell stock, or maybe you've inherited money, or maybe one year you have an unusually high income year, and then suddenly Medicare premiums increase. And now they begin to wonder, why is this happening? Why am I paying so much more in Medicare premiums? So today, I want to break this down in a very practical, simple way. I'm going to go over what IRMAA is, how it works, why it matters, what causes it, and some planning strategies that can help you reduce IRMAA. So first, let's understand what IRMAA stands for. It's Income-Related Monthly Adjustment Amount. So basically, it is an additional surcharge that is added to your Medicare premiums when your income exceeds certain thresholds. So this surcharge impacts your Medicare Part B and Medicare Part D. Most retirees assume that everyone pays the same Medicare premium, and that's simply not true. Higher income retirees pay more. IRMAA is based on your income from 2 years prior. So your Medicare premiums in 2026 are based on your 2024 tax return. Now, just that alone, you simply say like, well, wait a minute. Maybe I was still working in 2024 and now I don't work anymore in 2026. I literally don't have that cash flow like I used to. Right. That delay is what really surprises people and catches them off guard. But Medicare constantly looks backwards those 2 years. So how big can this actually cost you, right? So why is it worth paying attention to? This is where people usually start paying attention, is when their costs increase, right? So for example, in 2026, Medicare is $202.90 per month per person. This might feel manageable. For many people, it is. But once IRMAA kicks in, premiums, that $202 can increase substantially, sometimes by hundreds of dollars per month, depending on your income. And as a reminder, for married couples, that means both spouses pay this surcharge. So let me give you a little more perspective. The standard Medicare Part B premium in 2026, like I just said, is $202.90 per month per person. If you're a higher income retiree, that premium can increase all the way up to nearly $690 per month per person. That's quite a bit, right? This means that if you're married couples could pay close to $1,400 per month just for Medicare Part B premiums alone. This doesn't even cover deductibles, or that doesn't include prescription drug coverage or supplemental healthcare costs. That is just for the Medicare Part B premium. So this is not always, clearly, that's not a small increase every month and then on an annual basis. For some households, if you're in that higher income bracket, your IRMAA can easily add several thousands of dollars per year in additional healthcare costs to you. And then suddenly that little Medicare premium is not so little anymore. And the frustrating part is that many people trigger it unintentionally, simply because they're not aware of IRMAA. So I'm here to help that. I'm here to educate you, to make you, again, not an expert, but aware of the impacts, the choices that you make, and the impacts, the rippling effects of what happens. So what triggers IRMAA? That's a great question, and that's where I like to get started to help you understand, because that's where most people don't understand. So it's not just triggered by salary. It's based on your modified adjusted gross income. So what impacts that? Okay, so common triggers are like a large IRA withdrawal, required minimum distributions, Roth conversions, capital gains from selling investments. So that would be your advisor, right? Even if you don't take a withdrawal from a brokerage account, but your advisor sells investments at a large gain. That's why we want to talk to your financial advisor, like, hey, where are my capital gains looking like? Because that also impacts IRMAA. If you sell real estate or business sales, dividend income, interest income, pension income, bonuses, and sometimes even certain inherited assets can impact IRMAA. And sometimes that trigger to IRMAA can happen during what was actually a good financial planning move. And I want to explain that a little bit, because I do have clients that get so worked up on IRMAA that they make poor decisions when, no, actually, we wanted to do this financial. Let me give you an example. I might recommend a Roth conversion. And I do if last week's episode was about the widow's penalty and I recommended doing a Roth conversion. Well, maybe that Roth conversion triggers IRMAA. So, okay, and maybe we will definitely evaluate that, but maybe that recommendation is still beneficial for you. So if I recommend a Roth conversion for a client because it creates a long-term tax savings, but we still need to evaluate whether that temporarily triggering IRMAA makes sense as part of that bigger picture. And I can assure you, I would address that in that recommendation. Hey, by doing this, here's the impact, okay? Because sometimes paying slightly more Medicare premiums today can significantly help you with your taxes later in life, and it's worth making that change. So this is why, again, proper planning really matters so much. And you don't want to do it in isolation. If your financial advisor asks to see your tax return, they should be asking. There's reasons why. They're looking for things like this. So another really unique aspect of IRMAA is that it works in tiers, okay, or like cliffs. What that means is that you can go just slightly over the threshold, and then suddenly your premiums skyrocket. They jump up. So because IRMAA operates as a hard cliff, if you will, rather than a gradual sliding scale, going even a single dollar over your modified adjusted gross income threshold, that will trigger the full surcharge for the entire tier. This is called the $1 penalty, because IRMAA uses these hard bracket cutoffs. Crossing a tier boundary by just $1 causes that substantial jump in your monthly Medicare Part B and Part D premiums. So let me give you an example. A married couple filing jointly, stepping from the baseline threshold for Medicare to tier 1, that means that their modified adjusted gross income is now $218,001. Now they face an extra annual premium cost of nearly $1,000. The financial jump for a single dollar can result in thousands of extra dollars in premiums per person over that 1 year. This is why tax planning and retirement becomes incredibly important, right? We're not just investment planning, not just estate planning, but that income planning. Because that income planning, or all of it, right? All of it impacts the other type, right? If we make income planning adjustments, that's going to impact your estate planning, right? If your estate planning is changing, that impacts the investment planning. And sometimes even those small decisions make big impact, right? Even if you have to make those decisions late in the year, it can help whether someone crosses into another IRMAA tier. There are 5 tiers in total. So each tier has a different threshold or a different cutoff. So how can we plan around IRMAA? This does not mean that people should become like worried about this or fearful of creating income or making financial moves, right? Like obviously, if you're paying IRMAA, you have good income. That's a good problem to have. So we don't want to become too overly concerned with IRMAA. My goal, that's not my goal or my intent. My intent here is just to educate you so you understand what's happening and how decisions impact you, right? So instead, we would just want to be intentional. Some of the strategies that we evaluate or that I evaluate with my clients, includes like that timing of a Roth conversions or spreading income across multiple years, managing capital gains. Of course, that's very strategic. Using qualified charitable distributions. That's where you can gift right from your traditional IRA right to a nonprofit if you're RMD age. We look at strategies like evaluating when to take Social Security, how to build those tax diversification buckets, and then, of course, coordinating retirement withdrawals across multiple account types, right? That's why we like the tax diversification buckets. That's huge here. I mean, you don't have all of your retirement assets trapped inside tax-deferred retirement accounts. You have them in a mix of different accounts, Roth IRAs, brokerage accounts, cash savings, and yes, those tax-deferred accounts. But that gives you the flexibility later when managing retirement income and taxes. Now, I also want to say something important here, again, to re-emphasize that avoiding IRMAA should not become the only financial goal. I sometimes see people become so focused on avoiding Medicare surcharges that they accidentally ignore larger opportunities that I recommend, like better long-term tax planning, Roth conversion opportunities, estate planning benefits, or the overall retirement flexibility. So sometimes when we trigger IRMAA temporarily, it is still absolutely the correct decision. The goal here is not perfection. The goal, again, is understanding the trade-offs and making informed decisions. So can you appeal IRMAA? Yes, sometimes. If your income dropped because of a major life event, you may be able to request a reconsideration. Many times, retirees aren't aware that this is an option, but it is. And here's how it works. It does take your time. I mean, you have to go through the process, but here's how it works. So Social Security only accepts appeals for specific qualifying life-changing events. And those include, and I'm going to list them, so I'll go slow, but those include retirement or reduction in work income, marriage, divorce or annulment, death of a spouse, loss of a pension, loss of income-producing property due to fraud, disaster, or disease, certain employer settlement payments, or filing an amended tax return showing a lower income. So if one of these situations applies to you, the next step for you is gathering all of the documentation to support that change in income. So those things may include, your retirement paperwork, or your final pay stub, a divorce decree, a death certificate, updated tax return, or a proof of an amended return. If the income reduction was caused by one of those above life-changing events, then you typically would have to file a Social Security form SSA-44. If the Social Security simply used was incorrect, there was wrong tax information, then maybe you don't have to file that form. You would just have to, there's certain numbers that you can call, or maybe you go into the Social Security office, but there's different processes for reconsideration for you. But majority of time, you would use that Social Security form SSA-44. And here's another important factor is that the timing matters. So you normally would have 60 days from the date that you receive your IRMAA notice to appeal the decision. So you'll get something in the mail, the IRMAA notice. So you have to pay attention to that. because then once you receive it, you have 60 days, okay? The forms for supporting documents can usually be mailed, can usually fax, or even hand deliver them directly to the local Social Security office. Here's the encouraging part, okay? If your appeal is approved, the adjustment is often applied retroactively, meaning that you may actually receive a refund from Medicare premiums if you've already overpaid. So if you receive an IRMAA notice and something doesn't seem right, pay attention to it. And if it doesn't seem correct, feels off, don't automatically assume that you're stuck with it. It may absolutely be worth reviewing. So in closing, if there is one thing that I want you to remember from today's episode, it's this, that retirement is not just about investment returns. It's also about understanding how taxes and healthcare costs, income timing, financial decisions, how they all work together. And unfortunately, IRMAA is one of those hidden costs that many retirees do not discover until it's already happening, simply because they weren't even aware of IRMAA to begin with. But knowledge is power. Knowledge creates options, and options create flexibility. And I'm here for it. Thank you so much for joining me for another episode of Her Money Revolution. If this episode was helpful for you, I love it if you would share it with someone preparing for retirement or currently navigating Medicare decisions. This would be a great episode for them. Until next time, keep building, keep believing, keep pushing, and keep blessing others. I'll see you next time on Her Money Revolution. Thank you for joining me today, and I hope you are feeling more empowered in your financial journey. Remember, follow and subscribe to Her Money Revolution on your favorite podcast platform, and share your feedback by leaving a review. I'd love to hear your biggest takeaway from today's episode. Until next time, stay inspired.